What's up, guys? Thanks for jumping on with me. We're going to talk about the infinite banking concept, but for your children. And this is what really got me into the business, because as you can see, I have a pretty beautiful 2-year-old baby daughter, and I've set this up for her. There's me, I'm the bald guy. That's my wife, Beth. My daughter's name is Stella, and I can't remember the name of the tiger from Aladdin, Raja or something. But yeah, this is us. This is my family. This is me and Stelly, and this is my wife, Stelly, and this is us at the beach. But this is why I got into the business, is because what I was able to set up for her, nobody knows about it. It's like setting your children up for success. And later on in this video, we're going to look at actual numbers and what that can look like. But remember, the infinite banking concept is not a product, it's a process. And we're going to get into that a little bit here in a bit too. It's not an investment, it's a banking alternative. So I don't like talking about life insurance with children in terms of using it for life insurance. There's arguments that it makes sense, but I just don't like to have those conversations. Any child's policy that I've ever set up, it's been a whole life, and it's been designed to be a banking alternative. And I don't think about it in any other way. There are other parts to it. I don't like to think about them. When I'm setting Stella's whole life policy up, when I'm setting that one up, I'm setting it up as a banking alternative for her. Whenever she takes it over, she doesn't have to loan her money to a bank, which if you're putting money into a bank account, you're giving a loan to that bank, and they're paying you like 0.01% interest on it. Would you let me borrow your money for 0.01% interest? Probably not. But we're letting banks do it all the time. They take our money and then they actually go do things. But we're not comparing this to an investment. We're comparing it to a banking alternative. And the problem in America, I love this quote, the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. I didn't grow up knowing this information. And if I would have known it, then I'd be a lot better off right now. But also, there was a point to where I thought that I knew what I needed to do with my money, and I was confident in it. And whenever I came across this concept and this strategy, basically the stuff that wealthy people know and do and how they use their money, it completely changed my perspective. But I had to be open to seeing it that way. I had to be open to changing my mind. Changing your mind is one of the most powerful things you can do. In my opinion, one of the big problems in our country right now is we have a lot of people that are just not willing to change their mind. They're not open to it. And if you're not open to changing your mind, then you're not going to hear anything that I talk about. Now, at the end of it, if you're open to changing it and you hear what I have to say and you still just aren't about it, then that's totally fine. I'm not saying you have to change your mind, but you need to be open to changing it. And I'm open to changing my mind. At the end of this, if you found something that works better, let me know. Maybe I'll start doing that instead of this. The mystery of money. What we have here, 3 columns. One is a payment calculator. This is future value, savings account at a bank. Let's start over here. Savings account at a bank. So here's the scenario. You have $25,000. Let's pretend you found the best bank in the world. The best bank. They're paying you 4% for keeping your money in that bank, which is obviously ridiculous because you're lucky to get paid 0.5%. But 4%, and we're going to keep it in there for 60 months, okay? Now, let's say, so we're getting paid 4%, but we're going to take out a loan. We're going to go to, let's say, Chase or Wells Fargo, whatever. We're going to take out a loan for $25,000, and we're going to pay 6%, and it's a 60-month loan. Okay, so we still have our $25,000 sitting in that account, earning 4%. We're paying 6%. Our monthly payment is $483.32, and we're going to pay that for 60 months. And I'm just curious, what's your first thought? Are we making money or are we losing money? We're earning 4 but paying 6. The total that we're going to pay is about $29,000. But how much have we earned? We've earned $30,525. We've made $1,600. Even though we were paying 6% and earning 4, we made money. But how? This is the first thing about money. This is what people that are wealthy know about money. And it's in this example, this concept, we're paying 6% on a decreasing balance, but we're earning 4% on an increasing balance. If we can make money paying 6 and earning 4, how much money do you think we can make if we were earning 6 and paying 4? A lot, right? And that's essentially what we're going to be doing. Yet the concept sounds cool, but what's the machine? What's the vehicle because like I said, it's a concept, it's a process, it's not a product. You can theoretically do this with all kinds of different vehicles, right? And you can. But there's one machine and one vehicle that works better than any other vehicle, and that is dividend paying whole life insurance policies from a mutually owned company. And I know I mentioned life insurance at the beginning of this. Some of you may be rolling your eyes. I can assure you that probably everything that you're thinking negative about this right now is probably misinformation. For example, one that I hear a lot is that you can't access your cash value for years. That's false. We can design it to where you can have access to cash value within 30 days. Another is that you could lose all your money. It's false again. Another is that it's a very expensive insurance and that term is cheaper. And that's like comparing apples to potatoes or apples to a chair, right? We're using this not as insurance, but as a banking system. If you want really cheap insurance and all you care about is the death benefit, then yeah, go. If you can get term, go get it. Also, term isn't permanent. But if you want to use this vehicle to create generational wealth, this is the one. You can't do it with term, can't do it with IULs, and you have to do it with a dividend paying whole life policy from a mutually owned company. These are the rules. They have to be around for over 100 years. Never missed a dividend payment, not once. That means through every recession, every depression, every economic downturn. They've always, every single year, paid a dividend. They can't say that we guarantee you're going to get a dividend, but if they paid it for 100, 120 years, can we pretty safely assume that we're going to get the dividend? I think we can. Why a mutual company over a stock company? Now, if you get a whole life through a company that's a stock company, it's not going to work. It has to be through a mutual company, because in a stock company, the owner is the stockholder. That means their financial obligation is to make money for the stockholder. And you may be wondering, what does this have to do with my child? We need to know about the concept before we start talking about the policy. Okay. Their financial obligation is to make money for the stockholder. Dividends are taxable and they're incentivized to take risk. And we don't want that when we're preparing for our child's future. I don't want them to be risking the money that I put back. In a mutual company, what that means is whenever you have a policy through a mutual company, you're a part owner of that company. That means that you get to enjoy the dividends from their profits, right? They have the financial obligation to make money for you, the policyholder, and the dividends are tax-free. Loophole they use is they classified it as a return on premiums. It's like a refund, but it's tax-free money that you're getting. And then long-term safety is the primary focus, which whenever I'm thinking about Stellas' future, I would rather be more safe. I don't want to put my money in mutual funds that could get eat up with fees and somebody else managing the money, and maybe it goes down, maybe it goes up, but I don't want to put it in a 401k that might not be there. We'll talk about that a little bit here in a bit. But yeah, life insurance on my child. Remember, like I said at the beginning, I don't like thinking about this as life insurance. I like to think of it as a banking, and that's what we're using it for, a banking system. I never have a conversation the life insurance death benefit part of this, because I don't want to be in that business, don't want to have those conversations. Somebody else can have those conversations and set you up for it. I could sell you that, don't want to, don't like to think about it, but I do like to think about setting Stella up for success, for financial success in the future, to where when instead of loaning her money to the bank to do whatever they want with, she puts money into her family bank and then gets more out than she put in immediately. That's what I like to think about. That's what I like to work with people on. If that's what you want, then you're in the right place. Here's some famous people who used the infinite banking concept through their whole life policies, and you'll recognize some. Walt Disney, he used his to fund the construction of Disney World. Ray Kroc used his to fund the employees' salaries, and whenever he partnered with the McDonald's brothers, everybody knows McDonald's. If you haven't seen the movie Founder, it's about this. It's really good. J.C. Penney, Doris Christopher, John F. Kennedy, lots of people, even the Rockefellers use it. They have a unique strategy where they use a trust. I've actually adopted this as well. And if you're curious about that, then we can definitely talk about it. But the trust is the beneficiary, and it's a way for them to not only create more generational wealth, but to preserve it. Because if you just save it and give it and send it to the next generation, all it's going to take is one or two bad apples to just ruin everything you've built. But the way they do it, it can't be ruined. That's why they're so wealthy. Where do banks put their money? It's a good question. Banks are actually, if not the largest holders of whole life insurance. And anybody who says that they're not, I just tell you this. Google it. Go to a .gov website. I think it's FDIC.gov, that you know it's legit. And you'll find out that banks own life insurance called BOLI. I know Dave Ramsey has said on a video that banks can't own life insurance. If you just a little bit of research will tell you otherwise. Banks own whole life insurance. Why do they own whole life insurance? One is because you cannot lose money in whole life. Nobody's ever lost money in a whole life policy. An IUL can't say the same. The banks need to, they have to do whole life. They can't do IULs because in order to get the top rating, the funds need to be in a place. Now, obviously, they're not putting 100% of their money in it, but they're putting, as you can see, it's in the billions. Where they put their money needs to be safe. It needs to be consistent. It needs to be considered really safe. And whole life is that. It's guaranteed to go up. They put whole life insurance on their key employees, executives, presidents, vice presidents, stuff like that. Then when they use that to pay them, they use that to pay the benefits, the bonuses, and then they also, whenever that person dies, passes away, they get the death benefit. They pay some of that to the family. They use it to get the next person to pay, stuff like that. There's types of whole lives that's specifically for businesses just like this. Now, what is money? Let's talk about what is money, because in order to have a conversation about this, we need to agree on what money is. The definition, what do you guys think the definition is? Most of you are saying the definition is means of exchange. And that's true. What's its purpose, right? It's to facilitate the means of exchange, right? To facilitate transactions. So instead of bartering, me trading my eggs for your shirt or whatever, we can have money that has a value, right? We went from bartering to gold, now to money that used to be backed by gold, that's no longer backed by gold, which just screws us all. But that's what money is. Do you believe in compound interest? Yes, most people here believe in compound interest. And what Einstein says is it's the eighth wonder of the world. It's one of the most powerful concepts in the world. Now, which companies use compound interest? Go ahead, let me know. Put it in the chat. What companies use compound interest? A lot of you saying banks, they actually don't. Because what do banks do with your money? They tell you to take advantage of the compound interest, but they don't do it themselves. What do they do with their money? You give them that loan, right? I just got paid, say, $10K. I'm going to put it in the bank. I just gave up the bank a loan of $10,000. That's essentially what I've done. They're not going to let it sit there and get compound interest. What are they going to do? They're going to take it and they're going to lend it to somebody, right? They're going to go lend it and they're going to make money off of it. Because of fractional reserve banking, they have to keep like 10% of it. But motion is a natural law in finance. Why do they tell you to take advantage of compound interest? Because they want you to leave your money in the account, to leave it in your 401k, to leave it in all these places that they can take it and they can go make money with it. That's exactly what they want. Why did I say earlier that compounding interest is one of the most powerful laws if now I'm saying that don't use it? We'll find out in a second. Now, I want to ask you, do you have an IRA? Do you have a 401k? How safe are those? What are the guarantees that you have that money whenever you need it at retirement? For one, with 401k, you can't even take your money out until you're like 59 and a half. I think it recently went to 62 and a half. I could be wrong, but 59 and a half, or you're penalized for taking your own money. And then there's no guarantee. I think the guarantee is that it won't go below zero. What you've done is you're putting money into a fund, and then what they're doing with your money is they're going out and gambling. They're investing in stocks. They're making the money with the fees and everything associated with managing that. If you look at what happened to the 401ks in the 2008 and 2009 when people needed it the most, when they needed to retire, it wasn't there. It was awful. I was young at that time, but you can read about it. You don't have to be 50 years old to remember that. You can go research it. Does it make sense to put it in a 529 plan where you can only access it for special education, stuff like that? That you can't even borrow against it. You can't even use the money to guarantees. We talked about guarantees. And another thing is who controls it, right? You put your money in an IRA, 401k, 529. Who controls that money? Not you. Somebody else does. I like to have control over the money. Now, let's talk a little bit about fractional reserve banking, because this is where things get crazy. Let's say we deposit $10,000 into the bank, right? Let's say your child deposits $10,000 into the bank, right? Stelly, she makes this deposit, boom. And let's say that this bank was the bank that we were talking about earlier. It's the best bank in the world. It pays me 4% on my money. Thank you, bank. Okay? And you're not going to find a bank that's paying you 4% for keeping it in there, by the way. What does this bank do? One, as soon as you deposit that $10,000, with fractional reserve banking, they just have to have a fraction in reserve. That's why it's called fractional reserve banking. So let's say they keep $1,000 and they're going to loan $9,000 out to help somebody buy a house at 7%. And then that money goes to somebody. And where does the money go? It goes back to the bank, right? And then the bank just got another $9,000 loan from this person. And now they can lend out $8,100 to help this person buy this car at 6%. And then it goes right back into the bank because everybody has a bank account and they're all giving loans to the bank. Now, out of the $8,100, they can use 90% of that to buy or to lend to somebody to remodel their home. And then it does again with debt. This is the big thing to understand here is the banks, when you deposit money, they're making anywhere from 500 to 1,300% on the money that you deposit into the bank. And the way they do that is because every time when you deposit money, they lend it out. And then let's say with the house example, you're buying the house from the seller, right? They lend you the money to buy the house. That money goes to the seller, puts it back in the bank. Boom, it's a new loan that the bank just got that they can go turn around and do it again. That's how they make so much money, is it keeps going in and out of the bank. And they just need a fraction of that to continue to go. Hopefully that makes sense. But now we're going to take a look at a different scenario. This beautiful money tree is that's the family bank that you've set up for your child. And in this case, this is the family bank that I've set up for Stella. All right, now this is just an example because the premium deposit, I like to call them premium deposits because it's like you're depositing it into your bank, but it's $10,000. Mine was $2,000 that I set up for her, but let's say $10,000. We're going to put it into our family bank, which is our vehicle for doing that is the dividend paying whole life. And all these things, like if I want to buy the house or the car or the remodel or go into debt for something silly, then I can borrow from my family bank. My family bank loans me the money. I go do it. Now, here's the thing. You want to play honest banker with yourself and pay your bank back with interest, but that 500 to 1,300% stays in the family, okay? And I would pay myself back with interest. Now, here's the cool thing is if you were to encounter a financial bind, you don't actually have to pay the money back. It goes out. If you don't, it comes out of the death benefit. But if you really want to take advantage of this, you always pay yourself back just like you borrowed money from the bank, because then you're going to earn even more from dividends, and it's going to open up money to be used later on, okay? The money goes in and out of your family bank, all right? The banks make between 400 to 1,300% on the money that you leave there. And what we're talking about is we're recapturing that we're already spending, okay? Because your child, Stella, with the policy that I've set up for her, whenever she takes control of that, whenever I give it to her, she can use that policy however she wants. She can use it to finance a car. She can use it for a down payment on a house. She can use it to go to college if she wants to, instead of going into tens of thousands, hundreds of thousands of dollars worth in debt with other banks. She can just take it from her policy and pay herself all that money. But this is a case study for using this concept to buy cars. We could either take out loans, which is the financing route. We can pay cash, which is the savings or money market route. Or we can do it the infinite banking way with dividend paying whole life, okay? So let's look at each one of these scenarios. First is the financing route, okay? One, obviously you have no savings in this route. You earn no interest because you pay interest, and you borrow from a lender at the highest market rates using future earning potential as collateral, okay? You're paying interest, you're not earning it. This just goes down, right? You're losing money. If you look at a house, for example, and you buy a $300,000 house, over the course of the 30-year loan, you're going to pay probably 2.5 times what the actual value of the house was. It's crazy. You go in the red. Now let's look at the saver, paying in cash, all right? You're paying in cash, and you think that you are good with your money that you've gotten around this. You don't have to pay interest, which is true. You don't have to pay interest because you saved. You actually can earn a little bit of interest as you're saving. But then you take all your cash and you spend it on, in this example, the car. You've done a couple of different things. One, you have given up the opportunity and the ability to earn further interest on that money. Two, you've reset your compounding interest. Okay. If you have, say, $100,000 and it's earning 4%, and you take out the $100,000, it's not earning 4% anymore. But with our family bank, it will be. And I'll show you how in a second. Hopefully that makes sense. Now, what's the difference? Finance, we're going in the red. The saver, the one paying with cash, they're in the green a little bit. They're not in the red as much, but see, there's a third way, and that keeps us in the green. And this way, we save our money and we use other people's money. Similar to that example earlier where we saved the $25,000. That was paying us 4%, and we borrowed at 6%, which the numbers are actually going to be reversed. We're going to be earning 5 to 6 and borrowing at 4 most of the time. The rates can change and everything, but the rates that you can borrow the money from is always going to be lower than the prime rate. He done it mine too. But we're going to use other people's money, and we're going to continue to earn uninterrupted compounding interest on our money. And the cool thing is, these loans are the easiest to get. You just take the money because they have the collateral already. It's the death benefit. And of course they're going to let it, you don't have to go through credit checks. You don't even have to pay it back. There's no paying back schedule. You want to just don't go away from this being like, I'm going to borrow the money and never pay it back, because then you won't really be able to take advantage of the full benefits of this. But you borrow from the lender at negotiated rates using your own money as collateral and continue to earn uninterrupted interest. This is how you stay in the green the whole time. Okay, you save it, you're earning that uninterrupted compound interest, you borrow, and you pay back that borrowed money, and that's how it's done. Let's look at the example. Auto financing. We buy the car at $35,000, 6% rate, $676 is our payment. The total of our payments is going to be $40,598. And then the value of the car after 60 days or months is $10,000. So cars depreciate really fast. Your rate of return is a big fat goose egg. It's actually less than zero, but that was being conservative. Now let's look at the alternative where we buy it through I like to call it a family bank. We're buying it through our family bank, through our specially designed whole life policy, and $35,000, 5 years, 5%, just like the other one. But wait, we have $44,469. We have, after borrowing and paying it back, where before we were out $40,598 that we would never see again. You never see that money again, never. But this, we have $44,469.85, and we still have the car that we can sell for 10 grand. This is the power of creating your own bank. And this $44,469 is going to continue to earn uninterrupted compounding interest for the rest of your life, for the rest of your child's life. That's that extra $4,000 in net return, that's going to continue to grow. Okay. Again, $0, the regular financing route, and then $4,000 net return just at 5 years, doing it this way, the infinite banking way, and a lot more if you look at the net return over 10, 15, 20 years, because this money is going to continue to grow. That money is going to continue to grow. Uninterrupted compounding interest. Got a question. Do you have a 401k, and is it underwater? This magazine here came out in 2009 during the big financial crisis, and it's titled Why It's Time to Retire the 401k and What You Can Do Instead. This quote says it all. The ugly truth, though, is that the 401k is a lousy idea, a financial flop, a rotten repository for retirement reserves. And what must seem like a cruel joke to many, the accounts prove the most dangerous for those closest to retirement, and this isn't how retirement was supposed to be. That was from October 19th, 2009. I think you can find this entire article online, but the 401ks are not as safe as they're advertised to be. It's just a timing thing. If your timing is bad, then you're screwed. And when you're at retirement age and you don't really want to have bad timing because you haven't got any more time, like, you're screwed. That's the best way to put it. And I would rather not be screwed. Here's a question you probably heard before. Would you rather have $1 million right now or a penny that doubled every day for 30 days? If you've heard the question before, that you know the answer. But at the end of 30 days, if we take the million, we have $1 million as long as we didn't spend it on a bunch of stupid stuff, which a lot of people would probably do. I can't honestly tell you that I wouldn't start spending it on stupid stuff. $1 million is a lot of money. Now, what is the penny that doubled every 30 days? What does that look like at 30 days? It equals $5,368,709.12. That's the power of uninterrupted compounding interest. You want to know something even crazier? If you can see the blurry image, I got this offline, so it looks bad. But look at where the money is on this penny. This is the penny that doubles every 30 days. And look where it's at on day 20. It's only at $5,242. What the heck? I thought this was going to be $5 million. We're 66% of the way through, and it's only $5,000. It exponentially grows the longer that it's in there. Slower growth at the beginning. Look, 10.4, 20.9, 41.9, all the way till we get to day 30 at $5.36 million. That's the power of compounding interest. Your money will always only go up. That's why Einstein called it the eighth wonder of the world, is because of what I just showed you. He who understands it earns it, and he who doesn't pays it. And most people pay it their entire life. And there's a reason that they don't advertise this all over the place, is because they want us to put our money in the 401ks, the IRAs, like the mutual funds. That we need to believe that they know what to do better with our money in order for them to continue to make it. If we knew what to do with our money, then they wouldn't be able to make money. We don't need them. That's what I was trying to say. I'm not going to go as much detail into this as I did in another video, because this is just an example of how this isn't a child's policy. This is an example of somebody that used their own policy, and they are a little bit different, but this is the power of it. They had $169,000 in debt, and if you were to take $469,000 and divide it, and let's assume that there's no interest, which obviously there is. You can see the amounts, the payments, the interest right there, the amount of months. But let's assume there's no interest, 0% interest. How long would it take you to pay that off at 25 grand a year? It'd be like 10 years, right? Now, with this example, what we're gonna do is we're gonna put $25,000 a year in. Year one, we put 25 grand in. And now again, this isn't a child's policy because you can't put this much into a child's policy, but this is just to show you the power of the banking concept. Like if you wanted to do this for yourself, you could, but 25 grand in, 14,366 is available. We pay off all these. That money we're going to pay to our bank. We're going to pay it to our family bank because we want to take advantage of that growth. Year two, we put another 25 grand in and we're able to pay off some more debts, this one, and then a little bit later, we're able to pay off that one. Year three, we do it again, 25 grand in year three, and we pay off this one now and this one. We're almost done and we're only 3 years in. I thought this was going to take 18 years. Right now, total, we put in 75K far. We've taken out about 50K in policy loans. How much is left in our policy? If we put in 75, take out 50, how much do we have left? If you said 25 grand, you were wrong. You actually have 75 grand because remember, we're taking advantage of the uninterrupted compounding interest. We're playing that the wealthy people play. We're not going to continue to earn money on this while we use this. We're going to pay this back. If we look at year four, year four, something really crazy happens. And that means, or what that is, I put in the 25 grand and I have more available from that 25 grand than I put in. This is at the point where, because it takes a few years for it to get to this point, usually it's usually year 4 or 5. But after this, that number keeps going up. I put in 25 grand, have about 26 grand available out of it, a total of 67. Next year I might put in 25 and have 27. The year after that, put in 25 and have 28.2. If you had a machine that gave you $1.25 back for every dollar you put in, how many dollars would you put in? Hopefully as many as you could put in without the machine breaking, right? And that's what we're doing here. At this point, it's not even like we're getting money back from the money that we put in immediately. And right here, we pay this condo off toward the end of the year. And now we're at the last item that was on that list, which is the house. At this point, we paid it down to 181. We're going to take all this, we're going to pay it to that. Still not paid off, but on year 6, we only put in 10,000 on year 6 and we pay it off. It took us 6 years to pay that off because we could have just taken that extra cash, the 25 each year, and put it toward just paid toward the debts, but that compounding interest has allowed us to pay this off a lot faster. And now every year after that, we're earning more. From that point is when it gets fun because you've paid off all your debts and you can take advantage of opportunities, investments, stuff like that. How much did we put in extra? It was $160,000 extra that we put in, and we paid off $469,064. That's pretty crazy. Now, the thing to remember is that you still owe money to your family bank. Yeah, you could lower your payment if you wanted to. If you could, I would try to keep the same payment still to your family bank. You give yourself the same terms that those lenders had given you because all that extra money is going to go to the cash value of your policy, which is going to grow even more. But if you just couldn't, if there was a year or 2 or 3 or for the rest of your life, you got into a financial position where you couldn't afford to pay anything toward this loan, you don't have to. Like, you can just not pay it. But again, we want to do this the right way, but I'm just letting you know, like, that is peace of mind. I actually want to take you inside because we've been talking a lot about the concept of the infinite banking. I want to take you inside my 2-year-old daughter's policy, Stellas policy, that I made for her and show you the numbers. This is my daughter's policy that I made for her. So like I mentioned in that video, I tell everybody I do not like talking about life insurance for children in the sense of using it as life insurance. Even though this is life insurance, I don't use it like that. I designed this to be a bank, pretty much a family bank for her that I'm going to give her when she turns 21. I don't like to have the conversations. You could argue that they need to be had. Somebody needs to do it. I don't like to do it. I could and get paid to do it, but I don't want to. I just don't feel comfortable having those conversations, having a kid myself. But I love to talk about using whole life as a banking system for your child. I freaking love it. The first time that I heard about life insurance for a child, my first reaction was that I'm not even going to consider it, don't want to think about it. That's before I found this out. When we're looking at this, so we have 2 columns. We have guaranteed and we have non-guaranteed. So the guaranteed section is pretty much if this company goes belly up, out of business, these are the numbers that we're going to get. And that's less likely than the non-guaranteed because this company has been in business for over 100 years. And they've always paid a dividend every single year through every depression, every recession, every economic downturn, every war, whatever happened, they paid a dividend. The chances of them going out of business isn't very likely. They just can't. They just have to show that part. Over here, you see the non-guaranteed assumptions. This is based off of the current dividend scale that they have, and they have to say it's non-guaranteed, but really this side is more likely than the other side because they've paid a dividend every single year for over 100 years, for nearly 120 years. So you tell me which one's more likely to happen. With this policy that I've set up, this is the policy that I got for my daughter, Stellas. She's $2,000 a year. You see, so here's the contract premium. I like to call it a premium deposit because I'm depositing it into her family bank that I'm going to give her when she's older. This is the increase in cash value right here. Now, I want you to pay attention to this column here, because remember, are we doing this for immediate benefit or are we doing this for long term? If you're setting something up for your child, we're looking at long term. Let's look at what it starts looking like long term. So just at year 6, this is what I like to call the singularity. What happens here in this example is at year 6, I put 2,000 in and I get more back for what I put in. It's a singularity. At this point, every year, I will get more back than what I put in, and it will keep going up forever. Okay? It'll never go down. I put 2,000 in, I get 2,067 back. The year after that, I put 2,000 in, I get 2,172. It's not even an expense anymore. I'm making money immediately every time. Every year, you see, like on the 10th year, I'm getting a 25% immediate return on that money. Now let's scroll down to 21, because that's whenever I'm giving this to her and she can pay her own bank and I'll stop paying it for her. So she's 21 years old. This is the 20th year in the policy. She puts $2,000 into her family bank that I've just given her, and she gets almost $3,800 immediately increase cash value that she can use for whatever she wants. That's almost 100% return on your money immediately. She has almost 50 grand at this point that she can use to finance a car, go to college, put a down payment on a house, whatever she wants to use it for, she can use it. I'm 30 years old. Let's go down. Let's check out what it's looking like when she is 30 years. At this point, when she turns 27, the premium goes down to $1,000. At 30 years old, so just 9 years later, she puts in $1,000 and she gets $4,200 back, almost $4,300. That's over 4 times her money. This is an asset. It can't go down. It only goes up. This is not being used as life insurance. It doesn't even look like life insurance right now. I don't design them to, like, there's a death benefit over here, but we ain't worried about that. But I mean, it will be beneficial for whenever she gets older and she has a family, a husband, and her own kids. She has insurance for life, so that is a benefit. Let's look and see what happens whenever she's 50. Okay, she's 50 years old. She puts in $1,000. She gets $10,000, and she has $225,000 of cash value she can use at 50 years old. There's people that are 50. My grandparents raised me, and they're mid to late 60s. They could have afforded $1,000 and they would have had this. But you know what they have? Hardly anything. Like my entire family behind me is, I mean, we would be considered poor. And not to get into my story, but that's why I like this kind of stuff, because I don't want that for Stella. Like my whole goal has been, from me on, my family's trajectory is changing. You might be listening to this because you have the same mindset. That's why I love this stuff. This is how you create generational wealth. This is how you leave a legacy. She's 50 years old. She's getting 10 times her money that she puts in. That's insane. Around 70 years old. She puts in $1,000 and she gets 22 grand back. That's insane. Like, this is why I love this stuff. Like, you can set one of these up for your child, and you've given them an asset that's going to continue to serve them for the rest of their life. Look, 70 years old, she puts in $1,000, gets 22 back. She has $540,000 in cash value that she can use for whatever she wants. You can actually, I haven't done the math on it, but for probably about 25 years, you could start getting tax-free, probably about 80 to 100. I don't want to spit out numbers because I don't want to be wrong and get roasted, but you can use this as tax-free retirement income. Look, when you get down here at 86 years old, it just gets crazy. Look how it's exponentially getting bigger. Just like the whole penny doubles for every 30 days thing. At day 20, it's only $5,000, but at day 30, so it's 66% of the way through, and it's only $5,000, and then at day 30, it's 5.3 million. Like, what happened? It's because later on, this stuff gets crazy. So at 85 years old, she puts in $1,000, and she gets $35,000 back. Now she has almost $1 million. At 86, she'll have $1 million in cash value. It's crazy. And then at 95, every year after that, she doesn't have to pay anything. Even though she's not paying anything, she's getting $45,000, almost $46,000. She's paying zero. Again, it's whole life. It's a life insurance product, but we're not using it like that. We're using it as a banking system. And then down here, when Stella does get really old and live the good life, and she's passed on, she's gonna have kids. And look at this death benefit right here that she gets. That gets paid out to her kids completely tax-free. What I've done and what I can talk you through is you set up a trust to be the beneficiary. The trust buys more life insurance on everybody in the family. It just keeps the thing going. So every generation you get wealthier and wealthier, and it just protects it from, I know there's going to be somebody in my generation that's just going to be stupid and waste their money. So I would like to protect my money from that person. I would probably have been that person in my early 20s that would have blown the entire generational wealth from 100 years. I would have and probably killed myself by doing it. Because if you guys have any questions, if you're watching this video, you have questions, just reach out to me, shoot me a text, give me a call. I would love to help you. This is what I love doing, setting up this family bank for their children. Like, because I'm a father myself, this is what I love to do. So I'd love to have the conversation with you, and I'll talk to you soon.